I watched my business partner turn $10,000 into $12 billion over the span of 60 years. I had a front row seat. I saw every dull year, every compounding decade, every decision that looked boring in the moment, but turned out to be magnificent in hindsight. And I watched him do it without any of the things Manguita Thuong Vien Ko. No lucky lottery ticket from fate, no whispered insider tip from some Wall Street backroom, no genius move that only anointed minds could discover. He did it using tools, information, and opportunities that were equally ko sancho, bat ki ngoi bin thuong kien nan nao. In those very same 6 decades, I watched thousands of intelligent, educated, hardworking people, many of them earning far more in a single year than we ever did, end their careers with almost nothing to show for it. These were not fools or slackers. They were doctors earning $500,000 a year who somehow retired broke or close to it. They were lawyers billing $400 an hour who left this world drowning in debt. They were engineers, executives, entrepreneurs, people far more technically capable than I ever was, people whose expertise I would never dare to challenge in their field. And yet, after decades of high income, they had almost no enduring wealth. The difference was not intelligence. I have never pretended to be the smartest man in the room. The difference was not work ethic. Most of them worked harder, in terms of sheer hours and stress, than I ever did. The difference was not character, not virtue, not talent, not education. The difference, in case after case, was a small handful of seemingly reasonable decisions about where to put their money and what to call an investment. Those decisions looked harmless, even prudent, when they were made. Some even looked virtuous. But over 30 or 40 years, the arithmetic of those choices was merciless. More specifically, the difference lay in 7 categories of so-called investments that they poured their savings, bonuses, and windfalls into, and that I avoided almost completely for my entire life. I did not avoid them because I was so brilliant that I could see the future decades in advance. I avoided them because I have a stubborn respect for arithmetic, a habit of reading history, and a long memory for watching other people lose money in the same ways over and over again. After 7 decades of watching capital flow quietly from one set of pockets into another, I noticed something that never stopped repeating. Certain pockets were reliably emptied. Other pockets were reliably filled. The pattern was boring, but the consequences were enormous. What I am going to tell you is not theory. I did not assemble it from academic papers to impress a classroom. It is not a prediction about some hypothetical future market. It is simply the accumulated observation of a long life spent watching where money actually goes, who ends up with it, and who merely thinks they're investing while they are being harvested. These 7 investments, taken together, have destroyed more wealth among people I know personally than stock market crashes, bad luck, recessions, and terrible timing combined. That is not hyperbole. It is an account of lived experience. The tragedy is that most of these people were not gambling in casinos or speculating on obvious nonsense. Most of them earnestly believed they were doing the right and responsible thing. They were following conventional wisdom. They were obeying their financial advisors, their parents, their peers, the talking heads on television. They were doing what everyone around them called safe, smart, conservative, mature. They were praised for their prudence while their financial future was quietly being hollowed out. Let me start with the first great wealth destroyer, the one I have personally avoided all my life, and yet one that perhaps 90% of Americans enthusiastically buy, renew, and recommend to their friends. Entire careers in the financial services industry are built around selling this one product. It has the word investment baked right into the sales pitch, and it is still one of the worst investment vehicles ever created. I am talking about whole life insurance, universal life, variable life. Every permanent life insurance policy that promises to combine protection with investment growth in one convenient package. The sales pitch is pure seduction. You need life insurance anyway, they say, which is true for a certain period of life. So why not buy a policy that builds cash value you can borrow against or withdraw for retirement? You're not just buying protection, you're building an asset. Tax advantage growth, guaranteed returns, the safety of an insurance product married to the power of investment growth. On the surface, it sounds perfect. A financial Swiss Army knife, a responsible, sophisticated move. Underneath, it is a mathematical booby trap. Here is what they almost never explain in simple, blunt English. When you buy a whole life policy, somewhere in the neighborhood of 50 to 100% of your first year's premium goes directly into the agent's pocket as commission. It does not go into your cash value. It does not go into some hidden investment account waiting to blossom years later. It goes into paying the salesperson who convinced you to sign. If you pay $5,000, the agent may receive something close to that, and you are left with a policy, a death benefit, and almost no cash value at all. During the next decade, the insurance company slowly and reluctantly begins to allocate a portion of your premium into an internal investment account, but only after subtracting the ongoing cost of insurance, administrative fees, mortality charges, marketing costs, and a healthy profit margin for themselves. Your money is forced to run an obstacle course of costs before a single dollar is allowed to sit quietly and compound on your behalf. By year 15 or 20, if you have not yet surrendered the policy out of frustration, you may finally see a cash value approaching the total premiums you have paid in. So, after a decade and a half of diligent investing, your statement might show that you have roughly broken even. At this point, any return they advertise, 4%, 5%, sometimes a bit more, is not a return on the total amount you paid. It is a return on the cash value left over, after all those costs have been siphoned away. They highlight the small pool of water left in the bucket and invite you to ignore the size of the bucket and the gallons that have already leaked out. Let me put real numbers on it. I had a friend who dutifully paid $5,000 a year into a whole life policy from age 30 to age 60, 30 years, $150,000 in premiums. At age 60, his cash value was about $168,000. 30 years of commitment produced $18,000 of growth, which is roughly a 0.4% annual return, less than the inflation rate in many periods, a guaranteed method for working hard and going nowhere. Now consider the alternative that he could have chosen with the same dollars. Suppose he had purchased a simple level term life policy for about $20 a month to protect his family, perfectly adequate for the risk he faced, and invested the remaining $4,160 each year into a broad stock market index, averaging 10% annually over the long term. At age 60, instead of $168,000, he would have had something on the order of $870,000. The gap between $168,000 and $870,000 is $702,000. That gap is the true cost of his whole life policy, not the line item labeled fees in the brochure, not the surrender charge. The cost was the $500,000 plus that he could have had but never built because someone convinced him that insurance and investing belonged in the same product. They do not. Insurance is for transferring risk you cannot afford to bear. Investing is for building wealth you cannot afford not to build. Combining them into one product is like insisting that your car must also be a boat and a helicopter, then acting surprised when it performs badly at all three and costs a fortune to maintain. I never bought permanent life insurance. When I had young children and real obligations, I bought cheap term coverage for a period when my death would have been a financial disaster for my family. As my assets grew and my family became financially secure, I let the term coverage lapse because my death no longer posed a financial threat. Every dollar I did not feed to a whole life policy was allowed to sit in businesses and stocks for 50 years. That one decision, all by itself, probably added 8 figures to my net worth. Not because I am a genius, but because I refused to let someone whose paycheck depended on my choice tell me what was in my best interest. The permanent life insurance industry is built on a devastatingly effective trick. They take a legitimate human need, the desire to protect one's family, wrap it in layers of complexity and jargon, attach enormous commissions to incentivize sales, and then present the whole thing in the language of responsibility, love, and prudence. Provide for your family, build their future, be the adult in the room. From a marketing standpoint, it is brilliant. From the standpoint of the buyer's net worth, it is a slow-motion train wreck. I watched my friend defend his policy long after I had walked him through the arithmetic. When we talked, he had been paying premiums for 25 years. I asked him a simple question. If you could go back to age 30, knowing what you know now, would you buy this policy? He thought about it, looked at the numbers, and finally said, no, absolutely not. So I asked, then why are you still paying? He said, because I've already put in too much. I can't just walk away from 25 years of payments. That was the moment I knew the insurance company had truly won. They had not only captured his money, they had captured his psychology. This is the purest form of the sunk cost fallacy. People stay inside bad financial arrangements, not because they make sense going forward, but because admitting a mistake feels more painful than continuing the mistake for another decade. Meanwhile, the agent who sold him the policy walked away with something like $50,000 in commission. My friend walked away with $18,000 of growth in 30 years. The insurance company pocketed hundreds of thousands in profit spread over the life of the contract. Everyone made money except the one person who actually needed to grow wealth. That is not investing. That is a carefully engineered transfer of wealth from the financially unsophisticated to the financially predatory. The second investment I have avoided is one that whole cultures build their retirement dreams upon. It is revered in folklore, in dinner table conversations, in glossy magazines. It combines heavy leverage with an illiquid asset and transaction costs that would embarrass a loan shark. I am talking about investment real estate, not the home you live in, which is a separate discussion, but rental houses, vacation homes that you justify as investments, commercial buildings, and the fashionable real estate trusts that are sold as sophisticated diversification. The story behind investment real estate is seductive in a different way. Buy property, watch it appreciate, collect rent, build equity, use other people's money through mortgages, retire wealthy. I have heard that story 10,000 times. I have seen hundreds of people follow that path, some with impressive energy and competence. Aside from a small group who bought the right properties at very low prices and held through multiple cycles, the outcome, when compared to simply owning great businesses through stocks, has usually been disappointing at best and ruinous at worst. Start with transaction costs. When you buy a property, you pay 3 to 5% of its value in closing costs. Title, appraisal, legal, taxes, and various fees whose names you do not remember a week later. When you sell, you typically pay a 6% broker commission. On a $500,000 property, that means you can lose $15,000 to $30,000 just walking in the door, and another $30,000 when you eventually walk out, before you have collected a single month of rent or seen a single dollar of appreciation. You may be $45,000 to $60,000 behind compared to where you would be if you had simply bought shares of a business on an electronic exchange with near zero commission. Then there are the carrying costs. Property taxes in many jurisdictions eat 1 to 2% of the property's value every year. Homeowners insurance takes another 1%. Routine maintenance, roofs, paint, plumbing, appliances, landscaping, averages another 1 to 2%, even in years when nothing catastrophic breaks. In round numbers, you can easily spend 3 to 5% of the property's value every year just to keep it standing and legally yours. On that same $500,000 property, that is $15,000 to $25,000 per year consumed before debt service. If you have a mortgage, the interest bill stacks on top of that. Real estate is also stubbornly illiquid. If I decide to sell a stock this afternoon, I can press a button and within a couple of days the cash appears in my account. If you decide to sell a property, you must list it, stage it, show it, negotiate offers, survive inspections, navigate appraisals and underwriting, sign mountains of paperwork, and hope that the buyer's financing does not fall apart at the last minute. 90 days is fast. In a downturn, 9 months is common. In a real crash, you might carry that investment for years, paying all the ongoing costs before you can exit at a loss. Then there is depreciation, not the tax kind that accountants use to reduce your bill, but the real kind. Properties age, roofs eventually leak, foundations crack, neighborhoods change, roads relocate traffic, school districts rise and fall in reputation. A house cannot pick itself up and move to a better location. A business can shift strategy, innovate, open new markets, redesign its products, and reposition itself. A piece of property just sits there, hoping the world continues to treat its address kindly. People love to talk about leverage as the great advantage of real estate. Put $200,000 down, control $1 million property. What they forget is that leverage amplifies losses as faithfully as it amplifies gains. When that $1 million property drops 20% in a downturn, the bank does not share your pain. The $200,000 of your equity has evaporated. The mortgage remains. I watched this happen to diligent, competent professionals in 2008. Doctors, lawyers, engineers had millions of net worth tied up in primary residences and rentals, all heavily leveraged, all backed by the assumption that real estate only goes up in the long run. They lost almost everything on paper, and many were forced to sell into the crater, turning paper losses into permanent ones. When I ran the long-term numbers decades ago, the pattern was already obvious. Over extended periods, broad stock market returns exceeded real estate appreciation by 2 to 3 percentage points per year. That may not sound like much, but over 40 years, 2 percentage points can mean the difference between $1 becoming $15 or $45. That is the difference between a comfortable retirement and multi-generational wealth. Yet people cling to real estate because it is visible. They can drive past their building, walk into their rental, lean on a kitchen counter they own. Stocks, by contrast, are entries in a brokerage account. They feel abstract and fragile. So they trade the invisible compounding of businesses for the visible headaches of dealing with tenants, toilets, and taxes. One friend of mine in the 1990s bought 3 rental houses, paying around $200,000 each, a total of $600,000. He spent 20 years managing them, chasing late rent, hiring contractors, arguing with plumbers, attending to leaks at inconvenient hours, paying rising property taxes and insurance premiums, dealing with local ordinances and occasional lawsuits. In 2015, he sold them for roughly $350,000 each, about $1 million in total. On the surface, he doubled his money and felt triumphant. But after we carefully deducted all those years of taxes, insurance, maintenance, periods of vacancy, and management costs, the internal rate of return was roughly 4% per year. Had he taken that same $600,000 and put it into a simple S&P 500 index fund, reinvesting dividends and doing nothing else, by 2015 he would likely have had around $2.4 million, with no midnight repair calls and no tenant drama. The difference, roughly $1.4 million, plus 20 years of evenings and weekends he could have spent with family, pursuing hobbies, or improving his career. That is the true cost of his successful real estate adventure. Now, I am not saying nobody should ever own real estate beyond their primary residence. I am saying that for most people, most of the time, investment real estate is a cleverly disguised trap. It flatters our desire to own tangible things, plays on our cultural myths about land and property, and feeds our illusion that we understand something simply because we can stand on it. But the mathematics, once you include all costs and compare alternatives, are often brutal. The third kind of investment I have largely avoided is, in many cultures, even more sacred than property. People have literally gone to war over it. It is held up as the ultimate store of value, the last refuge when everything else collapses. I am talking about gold, silver, and other precious metals, and by extension, any non-productive commodity that does not create new value but is hoarded in the hope that someone will pay more for it later. The case for gold relies heavily on history and fear. It has held value for 5,000 years, they say. It is a hedge against inflation, a shield against the collapse of paper money, a finite, tangible asset that no government can print out of thin air. All of that sounds comforting, and some of it is technically accurate, but very little of it has much to do with building wealth over a lifetime. Let us examine the record. From 1975 to 2023, gold rose from about $165 an ounce to around $2,000 an ounce, roughly a 12-fold increase. Not bad, until you compare it with productive assets. Over a similar span, the broad stock market, with dividends reinvested, increased roughly 90-fold or more. $1 in gold became 12. $1 in businesses became 90 or more. And gold does not just sit there for free. Physical gold must be stored, insured, and protected from theft. If you use an exchange-traded fund, you pay management fees. Every layer of safety shaves a bit off the return until your 12 might realistically be 10. Meanwhile, stocks were paying dividends, increasing earnings, and compounding at a rate that makes the gap almost comical. Gold does not produce anything. It does not manufacture goods, provide services, or hire employees. It does not solve problems or invent new products. It does not generate cash flow. You buy it, you sit on it, and you hope that one day someone, somewhere, will want it more than you did and be willing to pay a higher price. That is not investing. That is speculation, dressed in antiquities clothing. People do not buy gold because of returns. They buy it for a feeling. The feeling of safety in crisis. The story that when paper money dies and governments go mad, gold will still be valuable. I have lived through the stagflation of the 1970s, the crash of 1987, the dot-com bubble, the financial crisis of 2008, the pandemic, and plenty of smaller panics. In every one of those episodes, the assets that truly mattered were claims on businesses that continued to produce things people needed and wanted: food, energy, medicine, technology, transport, communication. Gold sometimes spiked for a while in those storms, then drifted back down. Businesses kept earning and compounding. The deeper problem with gold is not numerical, it is psychological. The committed gold bug does not hold a hypothesis that can be disproven. If gold goes up, they are vindicated. If it goes down, it is temporary manipulation, a buying opportunity. If it goes sideways for a decade, it is still preserving value, while everything else is in a supposed bubble. This is not an investment thesis, it is a belief system. And as with most belief systems, the main benefit it provides is emotional comfort, not tangible improvement. I have never owned gold as an investment, not a coin in a safe, not a bar in a vault, not a shares of a gold ETF. Every dollar I might have funneled into gold went instead into businesses that produce goods, services, and cash flows. Over many decades, that decision has multiplied my wealth by an amount so large that I do not bother estimating it precisely. If I had followed the common advice to keep 10% of my assets in gold as a hedge, I would be millions of dollars poorer today. The fourth category I have consistently avoided is the world of high-fee managed funds. Actively managed mutual funds, hedge funds, private equity funds, and any structure where you pay someone 1 to 2% per year, plus a share of profits, to invest your money for you. This may be the single most profitable business ever invented in the financial world, and it has persisted for decades because it appeals to one of the deepest weaknesses in human nature, the belief that a talented expert can bend reality for us, and that it is worth paying handsomely for their magic. The basic pitch is, again, seductive. Markets are complex. You are busy. We have a team of analysts, proprietary models, and seasoned managers. Pay us a small percentage each year, and we will deliver superior returns, adjust to risk, and steer you through volatility. The problem is that the arithmetic of fees and the actual performance data tell a very different story. A typical actively managed mutual fund might charge 1.3% per year in expenses. It does not sound like much. Many investors barely notice it on their quarterly statements. Over 30 years, however, that seemingly small drag can consume roughly 35% of your total return compared to a low-cost index fund. And that is assuming the manager matches the market before fees, which the vast majority do not. Over 15-year periods, roughly 90+% of active managers underperform their benchmark after fees. Over 20 or 30 years, the number of managers who beat low-cost index funds shrinks to a small handful, and it is nearly impossible to identify them in advance, which means that if you choose an actively managed fund, your odds of doing better than a simple index are maybe 2 or 3%. Those are not odds. Those are near certainties of underperformance dressed up as sophistication. I watched the hedge fund boom closely. 2 in 20 was the standard arrangement. 2% of assets under management every year, plus 20% of profits above a certain hurdle. In good years, some funds posted spectacular returns, 30%, 40%, even more. Investors boasted at cocktail parties about being in with this or that star manager. Then more capital poured in, strategies grew crowded, the edge evaporated, returns drifted back towards the market, but the fee structure did not. I met a hedge fund manager in 2003 who had compounded at 30% annually for 5 years on $50 million. He was unquestionably skilled. I asked him what he thought his returns would be if he had to manage $5 billion instead of $50 million. He paused for a long time, then admitted his strategy did not scale that far. At $5 billion, he would have to do very different things, and returns might fall to the low teens, if that. But with 2 and 20 on $5 billion, he would personally earn over $100 million a year even if his investors received only 12% before taxes. It dawned on me very clearly that the primary economic engine in that structure was not investor wealth. It was manager wealth. The incentive system was perfect for the managers and terrible for the clients. They were paid handsomely on the upside, paid a base fee regardless of performance, and did not refund losses on the downside. Heads they win, tails you lose. I chose not to participate. I never put a dollar into a hedge fund. Once index funds were available, I gradually shifted away from actively managed mutual funds as well. Every dollar I might have handed to a star manager went instead into low-cost index funds or individual stocks I had studied myself. Over 40 years, that choice likely made a difference of tens of millions in my net worth. Not because I was the world's greatest stock picker, but because I refused to pay 1 to 2% a year for the privilege of underperforming what I could get for almost free. The fifth thing I never bought, and this will anger a lot of younger people, is cryptocurrency. Bitcoin, Ethereum, the endless string of coins created every week, all marketed as the future of money, the new gold, a revolution you cannot afford to miss. I watched the entire phenomenon unfold with a mixture of amusement and horror, because it distilled into one arena every pattern of financial delusion I had seen over 70 years. Tulip mania, the South Sea bubble, the dot-com frenzy, the housing bubble. All the old stories wrapped in new jargon and new technology. Proponents insist that crypto is a currency, a store of value, a hedge against government overreach, a transformative technology. In reality, it has not functioned as a stable currency because very few people price goods and services in it. It has not functioned as a reliable store of value because its price has swung wildly. It has not functioned as a productive asset because it produces no cash flow. It is, at its core, a digital token whose price is determined almost entirely by what the next person is willing to pay. That is speculation in its purest form. Scarcity alone does not create value. I could decide that only 21 million mirror coins will ever exist and encode that in a piece of software. If nobody wants them, they are worthless. What matters is usefulness. For most buyers of crypto, the usefulness is simple. They believe the token will go up. That is not utility. That is hope. The story that governments cannot control it, that it is decentralized, sounds rebellious and romantic, but it ignores the basic fact that most people interact with crypto through centralized exchanges that can be regulated, hacked, or mismanaged. It also ignores the economic reality that a truly deflationary currency, one expected to become more valuable simply by being held, discourages spending and can stall real economic activity. Blockchain technology may well find durable, boring, profitable uses, but you do not need to own a volatile token to benefit from a useful protocol, any more than you needed to buy shares of every dot-com company in 1999 to benefit from the internet. The great majority of human benefit from a technology accrues to users, not early speculators. The market tends to reward a small set of companies that harness the technology in profitable ways, often years after the initial frenzy has died down. I have seen Bitcoin rise from $1,000 to $20,000, fall to $3,000, rocket to $60,000, and plunge again. Each surge brought in a new wave of believers certain they had found a shortcut to wealth. Each collapse wiped out a large group of latecomers and set the stage for the next narrative. The consistent winners were those who sold early, and the exchanges that collected transaction fees every time the crowd rushed in or out. I chose to sit that carnival out entirely. Not a single dollar of mine has ever been in cryptocurrency. I preferred boring businesses that make products, serve customers, and generate profits. Those made me rich. The sixth investment I largely avoided is perhaps the most paradoxical of all, because it is sold by serious people as the essence of safety and prudence. Individual bonds and bond-heavy portfolios. You lend your money to governments or corporations. They promise to pay you a fixed rate of interest and return your principal at maturity. No wild swings, no drama, everything predictable. The problem again emerges when you take inflation and taxes seriously. Suppose a 10-year Treasury bond yields 4%. Inflation is running at 3%. At first glance, you are earning 1% above inflation, except you have to pay taxes on the full 4% of nominal interest. If you are in a high tax bracket, you might lose 1.5% to taxes, leaving you with 2.5% nominal, which is actually 0.5% below inflation. In real terms, adjusted for what money can buy, you are losing ground slowly and predictably. Your account statement looks stable. Your purchasing power slowly erodes. If you buy a 30-year bond in those conditions and hold to maturity, the government will faithfully return your principal in nominal dollars. But those dollars will buy much less. You will have preserved the number printed on your account and quietly surrendered a large portion of its real value. That is not safety. That is a guaranteed, invisible transfer of wealth from saver to borrower. There have been brief windows, such as the early 1980s, when interest rates far exceeded inflation. Bonds purchased then at double-digit yields offered genuine, attractive real returns. But those periods are rare. For most of the last half-century, bond yields have hovered close enough to inflation that after taxes, investors earned little or nothing in real terms. During the same spans, stocks have delivered returns that not only outpaced inflation, but allowed for real growth in purchasing power. The financial industry loves bonds because they create products to sell. Bond funds, ladders, structured notes, fixed income portfolios. Advisors can rebalance them, discuss them, collect ongoing fees on them. And because bonds are less volatile than stocks in the short run, clients feel safer holding them, even while they may be guaranteeing themselves a poorer future. Once again, the gap between emotional comfort and mathematical reality is enormous. I have almost never devoted a large portion of my wealth to bonds. At times, I held short-term instruments for liquidity to ensure I could act when opportunities appeared, without being forced to sell stocks at a bad moment. But as a long-term store of wealth, I have preferred the risks and rewards of owning productive assets. Over half a century, that preference likely added tens of millions to my net worth, compared to a more balanced allocation that felt safer but compounded slower. The seventh and final investment I have avoided will sound strange on a list like this, because most people do not call it an investment at all. It is sold as a lifestyle choice, a reward, a symbol that you are doing well. I am talking about new cars, luxury vehicles, and more broadly, expensive depreciating toys. This might be the single most common way otherwise intelligent people quietly sabotage their wealth. The average new car in America now costs around $48,000. Most buyers finance it over 5 or 6 years at 5 to 7% interest. By the time the loan is paid off, they may have shelled out $54,000 to $57,000 for an asset that is worth perhaps half its original price, often less. Then, just as the car becomes truly economical, no payment still runs. Many people trade it in and start the cycle again, keeping themselves in a permanent state of automotive debt. The real cost of that car is not just the sticker price plus interest. The real cost is what those dollars could have become if they had been invested instead. $48,000 invested at 10% annually grows to roughly $124,000 in 10 years, about $314,000 in 20 years, and in the neighborhood of $815,000 in 30 years. That is the potential that dies the moment you drive the car off the lot. Multiply this pattern over multiple vehicle purchases, and you are looking at giving up a small fortune in exchange for that new car's smell, and a few years of impressing other people who are themselves usually broke. People justify it with phrases like, "I need something reliable," as if the only reliable vehicles are new ones, or "I deserve it after working so hard," as if the universe pays attention to such arguments. A modest used car from a reputable manufacturer, carefully inspected and maintained, can deliver reliability at a fraction of the cost. The difference is not performance on the road. The difference is performance in your net worth. If I had to start over today with nothing, I would follow a very simple, very boring script. I would buy term life insurance if I had dependents and exactly zero permanent life insurance of any kind. I would rent a modest place or buy a small affordable home that I could pay off quickly. and I would refuse to treat my house as an investment strategy. Every spare dollar beyond a sensible emergency fund would go into the lowest cost total market index fund I could find, and I would plan never to sell unless I needed money far in the future. I would own no gold, no cryptocurrency, and only enough short-term fixed income to cover true liquidity needs. I would not pay a percentage of my assets to any advisor whose incentives were misaligned with mine. I would drive an inexpensive, used, reliable car and keep it until the cost of repair clearly exceeded the cost of replacement, then repeat the process. I would spend money on only a few categories that reliably compound in value in a different sense: my education, my health, my relationships, and tools that increase my earning power. I would save at least 50% of my after-tax income for as many years as I could stand, and when my income rose, I would let my lifestyle lag behind for as long as possible. Then I would wait. I would ignore the daily financial news, which is mostly noise. I would avoid people trying to sell me complexity. I would think in decades, not months. Compounding at 8% doubles the money roughly every 9 years. Over 30 years, that is 3 doublings. $1 becomes 8. $100,000 becomes 800,000. 500,000 becomes 4 million. And that is before you consider that as your skills, career, or business grow, you can add new savings to the pile each year. The only real question is whether you can stay out of your own way long enough for this to work. Most people cannot. They get talked into permanent life insurance in their 30s. They buy investment properties in their 40s because everyone they know at work is doing it. They panic into gold during crises because television tells them everything is collapsing. They pay high fees to star fund managers for decades. They chase cryptocurrency because they cannot stand watching other people post gains online. They retreat into bonds when markets wobble because they crave stability. They buy new cars every 5 years to reward themselves. By 65, they have a scattering of complicated products, some stories about bad markets, and far less wealth than they might have had if they had simply bought a boring index fund at 25 and never touched it. That is the quiet tragedy of modern personal finance. The solution, by contrast, is almost offensively simple, costs nothing, and requires no special talent. Avoid the 7 wealth destroyers, own productive assets for a very long time, and live below your means. I spent 70 years being consistently boring by most people's standards. I avoided the investments that made for exciting conversation. I bought businesses, often indirectly through index funds and a handful of individual stocks, and held them. I let arithmetic and time do the heavy lifting, and I refused to let salesmen or crowds dictate my choices. That, more than any secret technique or stroke of luck, is why I ended up financially comfortable, while so many bright, capable people did not. You can call that old-fashioned if you like. I call it respecting reality.